Something just snapped inside the financial system, and the silver market is where the damage became visible first. Behind closed doors, banks quietly tapped the Federal Reserve for $17 billion in emergency liquidity. Not because of stocks, not because of crypto, but because silver shorts began collapsing faster than models predicted. This wasn't supposed to happen. Silver was supposed to stay manageable, controllable, and boxed in by paper contracts. Something just snapped inside the financial system, and the silver market is where the damage became visible first. Behind closed doors, banks quietly tapped the Federal Reserve for $17 billion in emergency liquidity. Not because of stocks, not because of crypto, but because silver shorts began collapsing faster than models predicted. This wasn't supposed to happen. Silver was supposed to stay manageable, controllable, and boxed in by paper contracts. Welcome back to Boring Silver Mystery, the channel where the quietest market signals reveal the loudest truths. The story unfolding right now isn't about silver prices alone. It's about leverage, confidence, and a financial system pushed beyond its limits. When banks tap the Fed for billions, it means something fundamental has broken. In this video, we'll break down how silver shorts became unmanageable, why liquidity suddenly vanished, and why this event suggests the end of an era for silver price suppression. This isn't speculation. This is what happens when reality collides with leverage. For decades, silver shorts were considered safe, routine, and profitable. Banks sold silver they didn't have, rolled contracts endlessly, and relied on predictable market behavior to keep prices contained. The strategy worked as long as volatility stayed low and physical demand remained secondary. But over time, positions grew larger, leverage increased, and confidence replaced caution. Shorts stopped being hedges and became structural bets against silver ever breaking free. This created a time bomb. When silver began rising faster than expected, losses didn't grow linearly, they exploded. Shorts that could once be rolled comfortably suddenly required real capital. The system assumed silver would behave. It didn't. Margin calls are where theory meets reality. As silver prices surged, banks were forced to post additional collateral to maintain short positions. What began as manageable adjustments quickly turned into liquidity drains. Collateral that was assumed to be available wasn't liquid enough. Assets that were marked as stable declined in value simultaneously. This created a cascade effect. The more silver rose, the more collateral was required, and the less available capital banks had to meet those demands. At that point, normal market operations stop. Survival takes over. That's when banks stop trading and start calling the Fed. Banks don't tap the Federal Reserve unless private liquidity is gone. Interbank lending tightens first. Repo markets strain next. When those avenues fail, the Fed becomes the lender of last resort. The reported $17 billion wasn't about opportunity, it was about plugging a hole before it spread. This wasn't caused by reckless speculation alone. It was caused by a system built on the assumption that silver would never escape control. When that assumption failed, the only solution was emergency liquidity. But liquidity doesn't fix shortages. It only delays consequences. The real problem wasn't price, it was metal. Paper silver can be created infinitely, but physical silver cannot. As shorts scrambled to hedge or close positions, demand for real metal surged. That demand collided with already tight inventories. The result was panic. When physical availability tightens, paper positions become dangerous. Banks realized they couldn't source metal fast enough to neutralize exposure. This is where shorts implode, not when prices rise, but when delivery becomes questionable. The system wasn't designed for this scenario. Injecting $17 billion sounds dramatic, but liquidity doesn't create silver. It doesn't mine metal, doesn't refine ounces. It only postpones default. Markets sensed this immediately. Instead of calming volatility, the Fed's involvement signaled stress. Traders understood that if banks needed emergency funding, the problem was bigger than price swings. Confidence eroded further. Liquidity kept institutions alive, but it did nothing to restore control over silver pricing. Once traders realized banks were under stress, behavior changed instantly. Shorts became cautious. Long positions became more confident. Volatility increased because fear replaced complacency. Markets moved not just on fundamentals, but on belief. The belief that silver was suppressed permanently died the moment banks needed the Fed to survive. That psychological shift is irreversible. Once trust in control mechanisms fades, price discovery accelerates. Emergency funding is rarely isolated. Once the Fed steps in, it sets precedent. Other institutions reassess risk, liquidity hoarding increases, credit tightens. These secondary effects matter more than the initial bailout. Silver shorts that survive this wave may not survive the next. Each intervention weakens confidence and strengthens the underlying trend. This isn't stabilization, it's erosion. Silver is not large enough to collapse the financial system on its own, but it is large enough to expose weaknesses. What we're seeing is not about silver, it's about leverage everywhere. If a relatively small market can force banks to seek emergency funding, what happens when larger markets experience similar stress? Silver is the warning shot, not the main event. After this event, suppressing silver becomes exponentially harder. Every short position carries greater risk. Every rally threatens liquidity. Banks will be more defensive, less aggressive, and far more cautious. That changes market structure permanently. Control doesn't disappear overnight, but it weakens with every failed defense. Silver is now operating in a different regime. The idea that silver could be endlessly shorted without consequences died. The Fed intervention didn't save the system, it exposed it. Once emergency funding becomes necessary, the illusion of stability collapses. From here forward, silver prices will be shaped less by paper contracts and more by physical reality. That transition is messy, volatile, and unstoppable. Banks tapping the Fed for $17 billion wasn't a show of strength, it was an admission of failure. Silver shorts didn't just lose money, they lost control. And once control is gone, price tells the truth. If you want to understand what's really happening beneath the headlines, you're exactly where you should be. Subscribe to Boring Silver Mystery. Stay curious. And remember, when banks panic quietly, markets are about to speak loudly.